Welcome back. You're watching the ET Money Show. It's time to talk about your investments in equity mutual funds. And there are several strategies that you can employ, but by and large, a lot of advisors will tell you that it's a good idea to diversify. To that end, there are a few mutual fund schemes that tell you that they do this for you. Flexi-Cap mutual fund schemes are meant to have the freedom to invest across various market capitalizations. And multi-cap, which was the erstwhile definition of Flexi-Cap, is meant to do just that. But are Flexi-Cap mutual fund schemes really doing what you want them to do in terms of the diversification that you should have? We're going to talk about this in a lot more detail. Hemant Rustagi of Wiseinvest Advisors is joining me. Hemant, good evening to you and thank you so much for taking the time. I guess we should start with a conversation about why it is important to diversify and what the definition of these schemes are. You're talking about Flexi-Cap, you're talking about large cap, mid cap, small cap.
Well, Alex, I think if we talk about diversification, it's very, very important, especially when it comes to investing in an aggressive asset class like equity. We all know that equity is quite aggressive and of course it has the potential to give you better return than any other asset class. But at the same time, I think you need to kind of create a balance between risk and reward. And I think that's where, diversifying your portfolio across market segments, across different philosophies and strategies, I think it's absolutely across sectors. It's very, very important. Before we get to the definition of these funds, I think it's important to understand as an investor what these segments actually are and what is the definition of these three segments of the market. As per SEBI's definition, the large cap companies are the top 100 companies in terms of market cap, and from 101st to 250th company in terms of market cap are mid cap companies, and any company which is beyond 251st is basically considered to be a small cap company. So as we can see that the universe of small companies, small cap stocks is much, much larger as compared to other two segments. If you look at the definition of these funds, the Flexi-Cap fund, as you rightly mentioned, is a fund where the fund manager has to invest 65% into equity. That's the only guideline which is there, and he has the flexibility to decide, how much exposure should be there in different market caps. But most of the fund that you see generally would have a bias toward the large cap, but there is flexibility depending on what is the view of the fund manager in terms of which segment will do well, where the valuations are. So this is as far as the Flexi-Cap funds are concerned. A large cap fund is a fund where the fund manager has to invest at least 80% of his assets in the large cap stocks. We just saw what is the definition of large cap companies. And the mid cap funds are the ones where the fund manager has to invest 65% of his assets in mid cap companies. And there is a flexibility in terms of the remaining 35%. He could either actually invest more in mid cap or maybe across different market segments. And a small cap fund is a fund where the fund manager has to invest at least 65% of the assets in small cap companies. The rest can be invested across market caps or even higher in the small cap segment. So this is broadly the definition of these different type of funds.
Before we delve a little deeper into Flexi-Cap and what it's meant to do, Hemant, just to stress on why the SEBI has probably thought about this classification, why mutual funds themselves divide it in this way. What is the potential for growth? So to explain the risk reward here, you would talk about large cap giving you a certain potential for growth. Small cap, on the other hand, you're talking about a number of companies that have a smaller market capitalization, but the potential to become larger companies, to grow very quickly. Is that how you understand it? That the potential for reward is significant, but there is also higher risk?
Well, I think absolutely. Look, the point is that we all know that there is a large universe of small cap companies in the marketplace. There are many companies that are under research. There is an issue of liquidity as far as the smaller companies are concerned, whereas liquidity is not that much of an issue when you talk about the large cap stocks and the mid cap stock, because you're talking about the top 250 companies in the market in terms of market cap. But of course, like I said, for anyone who wants to build a portfolio, the key is also, apart from asset allocation, is to create a balance between risk and reward. See, if you talk about Flexi-Cap fund in greater detail here, look, there are two decisions that any investor has to take. One is decide the asset allocation. And second is, once you've decided how much money will go into equity, to decide how much allocation should be there in different market segments. So, what we have seen over the last few years, investors have learned a lot, done a lot of work in terms of asset allocation. You see increasing number of investors kind of adopting goal-based investment process where the time horizon is the key. So what we are seeing is that money which is, there for the longer term goals, important goals like retirement planning or child education, we are seeing more allocation towards equity because you need to earn a positive real rate of return. And for the money for the shorter duration, the focus is on safety of capital. So as we can see, there is a lot that investors have learned, and I think there are obviously many who are still in the process of learning it. But the tricky part is the second one, to decide how much allocation should be there in different segments of the market. Now, the advantage of investing or the role of a Flexi-Cap fund is that because investors find it tricky, one, to decide how much allocation should be there, and second is when to rebalance that, when to kind of increase allocation to small cap companies or the mid cap companies, or kind of increase allocation to large cap. I believe that when you're entrusting money to a professional fund manager, leaving this decision, especially if you're not having the wherewithal to decide how much allocate professional fund manager, leaving this decision, especially if you're not having the wherewithal to decide how much allocation should be there, I think Flexi-Cap funds really make sense. And there are a couple of other advantages, Alex, here. I would like to highlight a couple of them. One is the fund managers try to maximize your return by changing the allocation, and obviously try to minimize the volatility risk. Look, I mean, the risks which are there attendant to investing in equity cannot be addressed. It can only be addressed by diversification. But here they can minimize the risk of volatility by changing the allocation for you. The second part is, we all know that rebalancing, both in terms of asset allocation as well as allocation to different segments, is very important, which means as an investor, you should know how to time it, which can be again very difficult. So you leave it to the fund manager in a Flexi-Cap because there is a flexibility to change allocation. And the third is this rebalancing exercise. When you invest in a Flexi-Cap fund, it becomes tax efficient for you because all these decisions are being taken by the fund manager. You as an investor are not doing anything. So obviously you're not kind of doing any redemption, not doing any switch. So there are no tax implications for that. Now, while at some point in time you need to pay tax, paying taxes at different stages of your portfolio building can actually eat into your return. So I believe that the Flexi-Cap fund, along with of course other category of fund like large and mid, and to some extent maybe multi-cap, can be the core of any investor's portfolio.
Glad you explained things this way, because and also I'm assuming, Hemant, at this stage that people are following a goal-based approach, because that's what we keep stressing on this program, that you need to identify what you are saving for, identify how much you need to save, and identify when you need it. These are the key questions that you ask before you decide what you're investing in. So I'm assuming that is already taken place. We're talking about now the last stage, which is what to invest in, and I'm glad you set the context for that. The reason I'm happy about that is that my next question is perfectly placed right now, which is, can the Flexi-Cap then form the core of your portfolio? The issue here is that Flexi-Cap in the recent past and over the past several years has had a very large tendency towards large cap. So in effect, it is a large cap fund, but it is called a Flexi-Cap fund.
Yeah, I mean, look, Alex, I think you need to put it in proper context here. So if you look at the allocation today, currently, I agree that majority of the Flexi-Cap funds have a very heavy exposure to large cap stocks, to the extent of, I would say, maybe 80 to 85 to 90% at times. There is minimal allocation to small cap stocks and some allocation to mid cap. But I think you will agree that in the current market-like scenario, where we've seen that the market volatility is there, and we've seen that the deeper fall that has happened in the mid cap and the small cap, I think it's very well serves the investors that if the volatility is reduced and the money is protected to some extent by increasing allocation to large cap. Yes, I agree with you. Even in the past, it has happened, but again, it was happening during the phase when the market breadth was very narrow. So what was happening? Only 10 to 15 stocks were the ones actually that were giving return. The rest of the stocks, even in the large cap, were not doing so well. So I think if this is what exactly a fund manager is supposed to do. So if a fund manager sees that this is how the market is going to behave from here on, and keeping that in mind, if the portfolios are realigned, I think that is what a fund manager is supposed to do. I'm sure going forward, when the economy gets better, when the markets become more stable, we will see higher allocation to mid cap and small cap. So I believe that one of the objective of the fund manager is also, apart from the fact that he has to kind of earn healthy return for the investor, is also to, like I said at the beginning, to create the right balance between risk and reward.
Just a point in terms of if somebody wants to do, has the wherewithal to do the diversification by themselves, is that a bad idea? And I also want you to point out whether Flexi-Cap can form the core of your portfolio or not, because in effect you're talking about 80% on not 80%, but you're talking about 60% of your portfolio in certain cases, which is forming the core, and you have a satellite allocation of 20% towards certain other things, right? It depends, of course, on the individual and their risk-taking ability and various other aspects, but you're talking about core and satellite. Can Flexi-Cap form the core?
Well, it can certainly form the core. Like I said, I think for any long-term investor, especially the ones who are not managing their portfolio very aggressively, I think having a bias towards large cap, I think is a good thing. But of course, look, there are a couple of other categories, like I mentioned earlier, large and mid. I really like that category. So I think it can be a combination where you can see a significant role being played by the Flexi-Cap as a core of the portfolio. But I think to an extent, large and mid, because that's where at least 35% of the money has to go into large and mid cap individually, and the remaining 30 can go in the large cap. So most of these funds are investing around 55-60% in large cap there, and to some extent, even you can have one multi-cap fund where you know that 25% each will be invested in large, mid, and small. So it's not that you just pick one or two off the shelf Flexi-Cap and say this is my portfolio. But I definitely believe that because of the flexibility that they provide to the fund manager in terms of allocation to different market segments, I think they can play a very significant role. Coming to the point of, like you mentioned, whether there is a merit in opting for individual funds for investing in different segments, yes, there is. And as you rightly mentioned, if you as an investor think that you have the wherewithal to decide your allocation to equity and your allocation to different market segments, I think it makes sense, because the bigger advantage there is one that you can pick and choose the right kind of funds. So when I'm talking about the right kind of funds, I'm not only talking in terms of performance, I'm also talking about in terms of consistency in performance and also the quality of the portfolio. But again, I think there is, what I've seen in the past is that there can be a tendency when you build a portfolio of individually of large, mid, and small, that when the markets are doing very well, the mid and small cap segments do very well. So there is a tendency among investors to go aggressively for those funds, which requires them to maybe kind of make haphazard changes in the portfolio later on. I think there is obviously a merit in that, but investors have to be very, very careful. Like I said, going for a Flexi-Cap, going for even the large and mid, makes your whole exercise more tax efficient, because you don't have to kind of come out of a fund and go into some other fund. So there is no timing involved, but there is tax efficiency there.
One very quick last question, Hemant. The tendency, especially when you're looking to build and you're diversifying yourself, is to invest in a lot of schemes. And I've seen this very often, people having 10, 15 mutual fund schemes. This is counterintuitive, right? Counterproductive.
It is. I think the fact remains that mutual fund by nature are diversified. So when you invest your money is invested across different segments, sectors, different investment strategies and philosophies. When you have too many funds, now I think let's understand this very quickly. There can be many funds. I'm not obviously talking about too many funds in the portfolio, because you have a debt portfolio, you have a hybrid portfolio depending on your time horizon. You may have even fixed maturity plans. So they can be obviously. Investors should not confuse that I should have only 4 or 5 funds in my entire portfolio. Within a goal, I have seen portfolios where somebody is investing 10,000 rupees in 10 funds. What happens? There is an overlap. You have 4 or 5 large cap funds. They all behave the same, right? So I think if you want to avoid overlap and if you want diversification in your portfolio in the real sense, you can actually very well achieve even with the selection of 3 or 4 funds. Select your funds carefully, select the category of funds carefully. You can have a much better diversification than having 10 funds in the portfolio.
Thank you so much, Hemant. Very nice having you on the show. Thank you so much for taking the time.
Thank you, Alex.
All right, we have to slip in a very quick break. More on the other side, so do stay tuned.